How are private equity funds structured? Have you ever wondered how private equity funds operate behind the scenes? Understanding their structure can give you a clearer picture of how they function in the world of capitalism. Private equity funds are typically set up as limited partnerships or limited liability companies. This design helps them pool and deploy capital efficiently within a capitalist market framework. At the heart of this structure are several key players. The first is the general partner, often referred to as the GP. The GP has the legal authority over the fund and makes all investment decisions. This entity manages the fund's operations and takes on legal liability. Usually, the GP is the private equity firm itself or a related entity. To align interests with investors, the GP commits some of its own capital to the fund. This is known as having skin in the game. The GP earns money through management fees and a share of the profits, called carried interest, which motivates them to perform well. Next, we have the management company. This is the operational side of the fund, employing investment professionals, analysts, and support staff. The management company handles the day-to-day activities, raises capital, and oversees investments. It typically receives management fees, which are a percentage of the committed capital. These fees cover salaries, research, and other operational costs. Often, the management company is a separate legal entity from the fund, providing liability protection for investors. Now, let's talk about the fund itself. This is the legal vehicle, usually a limited partnership, that pools capital from investors to invest in private companies. The fund is where limited partners, often called LPs, commit their capital. The limited partnership structure limits LPs' liability to the amount they invest and allows for pass-through taxation. This means that gains and losses are reported directly to investors, avoiding taxation at the fund level. Limited partners are the investors who provide most of the capital but do not manage the fund. They enjoy limited liability, risking only the capital they commit. LPs are typically institutional investors, pension funds, endowments, or high-net-worth individuals. Their role is mainly financial, trusting the GP and management company to manage investments effectively. From a capitalism perspective, this structure aligns the interests of capital providers and capital managers. It encourages efficient resource allocation to generate returns. The limited liability and pass-through taxation make investing less risky and more appealing, promoting capital formation. The profit-sharing model for the GP incentivizes active management and value creation in portfolio companies, driving economic growth and innovation. Private equity funds are closed-end, meaning they raise capital during a specific period and invest it over several years. After that, they exit investments to return capital and profits to LPs. This life cycle fits well with capitalist market dynamics, where capital is directed toward ventures with growth potential. Returns are realized through market transactions like sales or public offerings. In essence, the structure of private equity funds balances control, risk, and incentives, allowing for efficient mobilization of private capital within a capitalist market. This supports economic expansion and wealth creation while adapting to market trends and analysis.